On a spring afternoon in 2008, a senior accountant inside one of the most powerful investment banks on earth does something almost nobody in his position ever does. He writes a letter, not to a friend, not to a reporter, to his own bosses. He tells them the numbers are wrong, and that he believes they already know it. Within days, he no longer works there. 4 months later, that bank, Lehman Brothers, a Wall Street institution older than the telephone, collapses in the largest bankruptcy filing in American history. The official story blames subprime mortgages and frozen credit markets, a crisis nobody could have stopped. That story is true, but it hides something else. For at least 2 consecutive quarters before the end, Lehman made $50 billion in assets disappear from its own balance sheet, on a schedule, on purpose, and then quietly brought every dollar of it back a few days later. The accountant who blew the whistle had a name for the mechanism the moment he first heard it. It sounded like a rat poison. This is how they did it. And this is the story of the one man who tried to stop it, 3 months before it was too late. Welcome back to Forensic Equity, where we take apart the machinery of corporate collapse piece by piece, so you can recognize it before it takes your money with it. Today's case doesn't involve a rogue trader or a Ponzi scheme. It involves something more dangerous, a technically legal accounting maneuver run through a 105% math trick that a bank's own employees privately called a drug and a gimmick. The tool was called Repo 105. On paper, it was a routine, short-term loan, the kind every investment bank uses every day. In practice, at Lehman Brothers, it became something else. A lever senior executives pulled at the exact moment investors were watching most closely to make a drowning bank look like it was swimming. The court-appointed examiner, who spent over a year investigating Lehman's failure, had a specific word for the picture this created. He called it materially misleading. NPR's own explainer, published the week the scheme became public, described it more bluntly. Lehman sold assets it fully intended and was legally obligated to buy back days later, solely to shrink the leverage number reported to the public at quarter end. Before we're done, you'll understand exactly how $50 billion can vanish from a balance sheet without a single dollar actually moving anywhere real. At the top sat Richard Fuld, the gorilla as Wall Street knew him, Lehman's chairman and CEO for over a decade. A man who had steered the firm through the 1998 Russia crisis and the dot-com crash, and believed, until the very end, that Lehman would survive this one too. Fuld took home roughly $250 million in cash and stock from 2000 onward, a figure he defended personally before Congress weeks after the collapse. To Fuld, Lehman's survival through 2 prior market shocks was proof the firm's judgment could be trusted a third time, a belief that outlasted the evidence against it. Beneath him, the chief financial officer's chair changed hands twice in the crucial period. Christopher O'Mara held it first. Then, in December 2007, Aaron Callan became Lehman's CFO. Young, media-friendly, frequently put forward as the face of the firm's stability on earnings calls. She was followed by Ian Lowett as Lehman's collapse approached. All 3 would later be named in the examiner's findings. Below the C-suite sat Bart McDade, appointed Lehman's internal balance sheet czar in January 2008 and promoted to president that June, a man whose own emails referred to Repo 105 as another drug we are on. And then there was Matthew Lee, a senior vice president in Lehman's finance division for over a decade, the kind of employee who actually read the numbers he was asked to sign off on. He is the reason we know any of this happened before the bankruptcy filing, not just after it. One more name matters here, even though it wore no human face. Ernst & Young, Lehman's outside auditor, which issued a clean, unqualified opinion on Lehman's financial statements every single year from 2001 through 2007. For 7 straight years, the firm whose entire job was to catch exactly this kind of misstatement instead signed its name beneath it. Here's the plain English version. Imagine you owe your landlord rent, but you're short on cash the week your bank statement is due. A friend offers a deal. Hand over your watch today, take cash for it, and buy the watch back in a few days, for slightly more than you sold it for. Ordinarily, everyone, including your bank, treats that for what it is. A short-term loan with your watch as collateral. The watch is still yours. It just temporarily changed hands. That is an ordinary repurchase agreement, or repo. Wall Street does trillions of dollars of them every year, and accounting rules correctly book them as financing. The asset never really left. It stays on the balance sheet. Now here is the trick. Under an accounting standard called SFAS 140, if you hand over collateral worth 105% or more of the cash you receive, put up $105 million in bonds to borrow just $100 million. The rules allow you to book the transaction differently. Not as a loan, as a sale. The watch on paper is no longer yours. The debt you took to get that cash is no longer your debt. Both simply disappear from your books until a few days later, when you buy it all back and the debt quietly reappears, right on schedule, right after your quarterly statement has already gone out the door. There was just one problem for Lehman. No law firm in the United States would sign the legal opinion required to justify calling these transactions genuine sales. So Lehman didn't ask a U.S. firm. It routed the trades through its London subsidiary and obtained the opinion it needed from the British firm Linklaters under English law, which no domestic accounting judgment would ever have to directly answer for. A bank doing something legitimate does not need to cross an ocean to find someone willing to bless it. Using this mechanism, Lehman moved roughly $38.6 billion off its balance sheet at the end of 2007's fourth quarter, $49.1 billion at the end of the first quarter of 2008, and $50.4 billion at the end of the second quarter. Each time, just before the numbers went public, each time, reversed within days. The effect on paper was dramatic. Lehman's reported net leverage ratio fell from 13.9 to 12.1 in a single reporting period. Not a rounding change, a whole point swing. Exactly when investors were watching leverage most closely as a sign of bank health. 2001, Lehman Brothers first introduces the Repo 105 program internally, years before anyone outside the firm would ever hear the term. Throughout 2007, as Lehman's exposure to a weakening real estate and subprime mortgage market grows, so does its reliance on Repo 105 at quarter end, climbing to $38.6 billion by year's end. Early 2008, Bart McDade is named Lehman's internal balance sheet czar as the firm's leverage concerns intensify behind closed doors. First quarter 2008, Repo 105 usage climbs to roughly $49.1 billion. And CFO Aaron Callan discusses the firm's ordinary repo activity on a public earnings call, without mentioning Repo 105 at all. Spring 2008, before his letter, Matthew Lee raises the same concerns verbally, repeatedly, inside Lehman's finance division. I've been telling you all year, I've been banging my head against the wall. May 16, 2008, Lee formalizes his concerns in writing, telling senior management he believes the firm's accounting practices possibly constitute unethical or unlawful conduct and are potentially misleading to the public and various governmental agencies. Days later, May 2008, Lehman terminates Matthew Lee as part of what the firm calls a general layoff. June 12, 2008, Lee independently informs Lehman's own outside auditor, Ernst & Young, of the firm's roughly $50 billion in Repo 105 usage that quarter. Second quarter 2008, Repo 105 usage peaks at approximately $50.4 billion, the largest single use of the mechanism in the firm's history. The point of no return. Ernst & Young, now directly informed by name of the exact scale of Repo 105 and of Matthew Lee's internal warning, does not escalate it to Lehman's audit committee and issues no qualification, no red flag, no pause. From this point forward, the firm's last remaining internal check has been informed and has stayed silent. September 14, 2008. With a weekend of emergency talks at the New York Federal Reserve failing to produce a buyer, the SEC issues a public statement addressing recent market events tied to Lehman Brothers. September 15, 2008. Lehman Brothers Holdings files for Chapter 11 bankruptcy protection, the largest bankruptcy filing in United States history. The SEC follows with a same-day statement confirming staff are on site, overseeing an orderly wind-down of Lehman's regulated broker-dealer, with customer accounts protected by SIPC insurance. October 6, 2008. Richard Fuld testifies before the House Committee on Oversight, telling lawmakers he will wonder, until the day they put me in the ground, why Lehman alone was allowed to fail. March 11, 2010. Court-appointed bankruptcy examiner Anton Valukas releases his 2,200-page report on Lehman's collapse, publicly naming Repo 105 for the first time. Red flag number 1. A leverage ratio that moves in whole points, not fractions, right at quarter end. Analysts are trained to watch small movements in a bank's leverage ratio, usually measured to a single decimal place. A whole point swing, 13.9 down to 12.1, that appears exactly at the reporting deadline and vanishes days later, is not normal balance sheet management. It is a flashing signal that something is being timed to a filing date, not to genuine business need. If the improvement disappears the moment nobody outside the company is looking, it was never a real improvement at all. Red flag number 2. A legal opinion sourced from outside the jurisdiction where the company actually operates. When Lehman could not find a single U.S. law firm willing to certify these repos as true sales, that refusal was itself the answer. Reaching across the Atlantic for a favorable opinion under a different country's law is a sign the domestic legal and accounting consensus has already said no. Forum shopping for a legal opinion is rarely about efficiency. It is almost always about finding the one jurisdiction that will say yes. Red flag number 3. Executives privately describing their own accounting practice in the language of addiction or deception. When your own staff calls a financial technique a drug or a gimmick in internal communications, that is not cynicism. It is an admission. People do not use the language of addiction to describe a tool they believe is legitimate. They use it to describe something they know they can't stop relying on. Red flag number 4. A public denial that doesn't match the internal record. Aaron Callan discussed Lehman's ordinary repo business on an earnings call, while Repo 105, the far larger, leverage-distorting program, went unmentioned entirely. What a CFO chooses not to say on a call built to reassure investors can matter more than what she does say. Red flag number 5. An internal whistleblower whose complaint is followed almost immediately by termination. Matthew Lee raised his concerns verbally for months, then in writing. Within days of the letter, he was gone. A company confident in the accuracy of its own numbers does not need to remove the one employee asking pointed questions about them. And the speed of that removal is itself a data point worth weighing as heavily as the original complaint. By the second quarter of 2008, Lehman was carrying the largest Repo 105 balance in its history. $50 billion in assets and liabilities that existed on every day of the quarter, except the one day the public was allowed to see the books. Investors, rating agencies, and regulators were assessing a leverage ratio that had never actually applied to a single ordinary trading day. Matthew Lee's letter, sent that May, should have been the moment the pattern broke. It was not his first attempt. For months beforehand, he had raised the same concerns out loud inside the building, telling colleagues, "I've been telling you all year, I've been banging my head against the wall." Only when speaking failed did he put it in writing, an act he would later describe in blunter terms. "It's like throwing a grenade. I wanted to wake somebody up." Instead, Lehman terminated him within days. In June, he went further, informing Ernst & Young directly of the scale of what he'd found. The firm's own outside auditor, the party whose entire professional function is to catch exactly this kind of misstatement, now had a name, a date, and a dollar figure. It did not escalate the warning to Lehman's audit committee. The last checkpoint that could have stopped this before the public ever saw the September headlines had already been passed, silently, 3 months earlier. What followed, 4 months after the auditor's silence, has been told many times, but never fully explained. A summer of failed rescue talks, a weekend of emergency meetings at the New York Federal Reserve, and finally, on September 15, 2008, Lehman Brothers Holdings, filing for Chapter 11. 158 years of history, ending in the largest bankruptcy filing in American history. The Securities and Exchange Commission, in a statement issued that same day, confirmed it had staff on site working to oversee an orderly wind-down of Lehman's regulated broker-dealer arm with customer accounts protected by SIPC insurance. 3 weeks later, in a House hearing room, Richard Fuld would tell lawmakers he still didn't understand why his firm alone had been allowed to fail. 18 months after the collapse, Anton Valukas delivered his findings, a 2,200-page report that for the first time put the words Repo 105 in front of the public. His conclusion was precise and damning. Lehman's accounting had painted a materially misleading picture of the firm's financial condition. And while the underlying business decisions might have fallen within ordinary judgment, the decision not to disclose their effects gave rise to colorable claims against Fuld and each of his CFOs, Christopher O'Meara, Aaron Callan, and Ian Lowett. Valukas was careful to define exactly what that legal term meant. Not mere allegation, but sufficient credible evidence to support a finding at trial. Against Callan specifically, the examiner went further, finding sufficient evidence to support a claim that she had breached her fiduciary duties both by causing Lehman to make materially misleading statements and by failing to ever inform Lehman's own board of directors that the Repo 105 program existed at all. And then, almost nothing happened. No criminal charges were filed against Fuld or any of Lehman's executives. The SEC's own inquiry into the matter closed without any public enforcement action. 2 years after the report's release, Valukas himself would say on camera that the evidence supported colorable claims that this was a fraud, and that no one had been held accountable for it. The one enforcement action that did materialize targeted not a Lehman executive, but the auditor. In December 2010, New York's Attorney General sued Ernst & Young, alleging the firm had been fully aware of Lehman's fraudulent Repo 105 transactions, and had specifically approved their use while still issuing a clean audit opinion every year from 2001 to 2007. That case, the first law enforcement action to come out of Lehman's collapse at all, ended in April 2015, with Ernst & Young paying $10 million to settle without admitting the underlying fraud allegations. It stood as the first enforcement action ever brought against a public company auditor under New York's own securities laws, and, to this day, remains the only completed enforcement action tied directly to an auditor's role in Lehman's collapse. Separately, in 2013, the firm paid $99 million to settle a private securities class action brought by Lehman's own investors and bondholders. Beyond the courtroom, the loophole itself was closed. In 2011, the Financial Accounting Standards Board eliminated the specific ability to repurchase criterion that Repo 105 had relied on to justify sale treatment accounting. And that July, in the broader wake of the crisis Lehman had come to symbolize, Congress passed the Dodd-Frank Wall Street Reform Act, creating new oversight specifically aimed at the kind of shadow banking and repo market activity that had gone largely unmonitored before Lehman fell. The first lesson is that fraud in modern finance rarely looks like theft. It looks like paperwork, a transaction structured at exactly 105%, timed to a filing date, blessed by a lawyer in a jurisdiction that will never have to answer for it. Nothing about Repo 105 required Lehman to break into a vault. It only required nobody outside the firm to ask why the leverage ratio moved in whole points at quarter end and nowhere else. The second lesson is that internal whistleblowers are often the only real-time defense a company has against itself, and that the speed of retaliation against them is itself a signal. Matthew Lee did everything right. He documented his concerns in writing, escalated them internally, and when that failed, took them directly to the outside auditor. He was terminated within days of doing exactly what governance structures are supposedly designed to reward. The third lesson is the hardest one. An auditor's silence can be as consequential as an executive's decision to deceive. Ernst & Young was told, by name, of the scale of Repo 105 and of an internal whistleblower's concerns 3 months before Lehman collapsed, and said nothing to the audit committee. The only price the firm ultimately paid was a fraction of what its own audit fees over those 7 years likely totaled. Lehman Brothers did not fall because of Repo 105 alone. It fell because a housing market collapsed under a bank that had spent years using a legal accounting maneuver to make its true exposure to that collapse invisible, right up until the exact moments regulators and investors were watching most closely. The mechanism was legal. The purpose, according to the man the courts appointed to find out, was not. What should stay with you is not the size of the number, $50 billion, but the size of the warning that came before it. One employee saw the pattern, wrote it down, and told the one institution positioned to stop it months before the headlines. The system had exactly one more chance to catch this before the public did, and it didn't take it. If this case has taught you anything, it's that the red flags are rarely hidden. They are usually sitting in a footnote, a leverage ratio, or a letter someone already tried to send. Subscribe to Forensic Equity and we'll keep finding them. Keki Sash. One case's file at a time.